Hi traders, you are welcome back to the Forex Geek channel. In this channel, we break down powerful trading strategies to help you make smarter decisions. In this video, we are diving deep into the DMI trading strategy, okay, and how to use the Directional Movement Index to spot strong trends, filter out weak signals, and improve trade entries. So this is the Directional Movement Index, or DMI for short. Okay, this strategy that we're going to be discussing is perfect for anyone who wants to trade with confidence by identifying whether the bulls or bears are in control and whether a trend is actually worth following. Okay, so before we get started, do me a quick favor, hit that like button, subscribe to the channel, and turn on notifications so you never miss a new trading video. Now let us jump right in. Alright, so what exactly is the Directional Movement Index, or DMI? The DMI is a trend following indicator developed by J. Wallace Wilder, and it helps traders measure both trend strength and trend direction. The DMI consists of three key components. All right, it consists of three key components. It consists of the positive DI, right? That is the positive directional index, or rather the positive directional indicator, which is the blue line. As you can see, the positive DI, which is the blue line, it measures the bullish trend. Okay, and then we have the negative DI. You can see it here, negative DI, which is the negative directional indicator, measuring bearish strength. All right, this orange line, and then we have the ADX, or the average directional index, this red line, which measures the overall trend strength. Now, by looking at how these three lines interact, we can determine the direction of the market, spot strong trends, and avoid getting caught in choppy price action. All right. Now, when the DI, remember that the DI is the blue line. Okay, while the negative DI is the orange line. So when the positive DI crosses above the negative DI, it signals bullish momentum, meaning that buyers are in control. On the other hand, when the positive DI crosses below the negative DI, it signals bearish momentum, meaning that sellers are taking over. But the real magic happens with the ADX line. Now, if the ADX, remember that the ADX is the red line. The ADX is the red line. So if the ADX is above 25, if you look at, you can see the values here, right? So if the ADX is above 25, okay, let's just all right. If the ADX is above 25, right, the trend is strong. Okay, and if it is below 20, if the ADX is below the 20 level, the market is weak or ranging. So this is key to filtering out bad trades. All right. Now that we know what the DMI does, let us break down how to use it in a trading strategy. Okay. So here's a simple but effective way to trade with the DMI. First of all, you have to set up the indicator, of course. Open your trading platform and you apply the DMI indicator. It's usually found under the trend indicators. Okay. And then you adjust the settings if needed, all right? But the default is fine, all right? You don't necessarily have to modify the inputs or whatever. The default 14 period is actually okay. It works well for most markets, all right? Then the next step is to identify the trend, okay? If the positive DI is above the negative DI, and the ADX is rising above 25, then we have a strong bullish trend. Okay, let's just see if we can find a very, very quick example. All right. Okay, we can see an example here. So when you have the positive the positive DI above the negative DI, and you have the ADX value above 25, it's a strong bullish trend. On the other hand, if the negative DI, right, if the negative DI crosses below, or rather, if the negative DI is above the positive DI, remember that negative DI is the orange line. So when the negative DI is above, right? Remember that for a bullish trend, the positive DI has to be above the negative DI. But for a bearish trend, the negative DI has to be above the positive DI. And the ADX, and if you have the ADX rising above 25, right? You have ADX rising above 25, then you have a strong bearish trend. All right? So now, for long trades, you have to wait for the positive DI to cross above the negative DI with the ADX above 25. Okay? Then for short trades, you wait for the negative DI to cross above the positive DI with the ADX above 25. Then you confirm the setup with candlestick patterns, support and resistance levels. Make sure you always have your support and resistance levels. They go a long way. Alright? Watch out for your trend lines as well, plus your candlestick patterns. Watch out for reversal candlesticks and all of that. Bullish and bearish reversal candlestick patterns, rejection candles and all, okay? In order to confirm your signals, alright? To get an extra layer of confidence. Okay? So once you have entered the trade, ensure to place your stop loss appropriately. Place a stop loss below the recent swing low. Right, that is for bullish trades, or above the recent swing high for bearish trades. Okay, then you can take your profits at key resistance or support levels, or you can even use a trailing stop to maximize your potential gains. All right, so by following this strategy, you can avoid weak trends and only enter trades when momentum is actually behind the move. Now, let us go over some common mistakes traders make when using the DMI strategy and how to avoid them. The first mistake is ignoring the ADX. A positive DI and negative DI crossover alone does not mean a strong trend. Always check if your ADX is above 25 before entering a trade. Second mistake is trading in choppy markets. If ADX is below 20, if your ADX is below the 20 level, the market is not trending. Okay, so avoid trading in those conditions, in such condition, okay? And the final mistake is not using a stop loss. Always protect your trade with a stop loss, especially in volatile markets. Alright? So here's a quick pro tip. Combine your DMI with support and resistance levels or moving averages to get even stronger confirmation before taking a trade. So there you have it, the DMI trading strategy explained. Now you know how to use the positive DI, which is the blue line, the negative DI or the orange line, and the ADX, the red line, to spot trends, filter out weak signals, and improve your trade timing. So which part of this strategy do you find the most useful? Let me know in the comments. And before you go, do not forget to smash that like button, subscribe to the channel, and turn on the notifications so you never miss another trading breakdown. Thank you for watching, and I'll see you in the next video. Happy trading.